November 2019, question 4, part C. So that question reads that Smooth Drive Limited, the Smooth Drive Limited is a motor vehicle assembly company issued a 10-year 16%. It issued a 10-year 16% shillings 100 million par value bond 5 years ago. The bond was issued at a 2% discount, and the issuing cost amounted to shillings 2 million. So due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunity for refinancing. So a financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings 100 million par value, 12% 5-year bond will be issued by the company. So issuing cost of the new bond will be 5% of the par value, and discount of 3% will have to be given to attract the investors. The old bond can be redeemed at 10% premium, and in addition, 2-month interest penalty will have to be paid on redemption. So all bond issue expenses, including the interest penalty, are amortized on the straight line basis over the life of the bond and are allowable for the corporate tax purpose. So applicable corporate tax rate is 40%, and after tax cost of the debt to the company is approximately 7%. So now required Roman letter 1. Initial investment. Initial investment required to issue the new bond. Initial investment required to issue the new bond. Roman letter 2, annual cash inflows or savings, if any. Annual cash inflows or savings, if any, that will be expected from the bond refinancing decision. Then also net present value of the refinancing decision. Then finally, they also wanted to advise. So those are basically the steps we normally follow when we carry out the bond refunding or refinancing. So let us start with the Roman letter 1. Initial investment required to issue the new bond. Initial investment required to issue the new bond. So we are looking at the initial investment. Initial investment to issue the new bond. Issue the new bond. So those costs are basically the penalties and the other discount and the issue cost that we normally incur when we are issuing the new bond. So one of the costs is meant to be the call premium. One of the costs is meant to be the call premium. One of the costs will be the call premium. Remember when we checked in the notes that we discussed in our last class, we had said that a call premium is simply a penalty for repaying the loan before the maturity period. So I would like you to go to the paragraph number 3. When you got the paragraph number 3, they said that the old bond can be redeemed at what percent? 10% premium. So it will be 10% of the bar value of the old bond. When you go to the first paragraph, when you check in the first paragraph, they had stated that a motor vehicle assembly company issued a 10-year, 16% shillings 100 million par value for five years ago. So it will be 10% of that par value of the old bond. So our call premium will now be, we simply take the 10% of the 100 million. It is there in the paragraph number 3. So what should be 10% of the 100 millions? So it will be 10 millions. It will be 10 millions. So we simply get 10% of 100 million. There are 3 zeros at the top, so we present it in that particular manner. So that is now the call premium. That will be able to give you the call premium. Then apart from the call premium, still on the same paragraph, they said that, and in addition, 2-month interest penalty will have to be paid on what? On redemption. That would be overlapping interest penalty. So we also add the overlapping. We also add the overlapping interest penalty. Also add the overlapping interest penalty. So they are saying that 2 months. They are saying that 2-month interest penalty will have to be paid on redemption. So you still go back to the first paragraph. You still go back to the first paragraph. So in that first paragraph, they were able to say that 16% shillings 100 million per value 5 years ago. So the interest per annum is 16%. So we shall be getting 16% of the 100 million. But now it is only for 2 months. 16% is per annum. So multiply by 2/12 to convert it to be for only 2 months, because 16% is per annum. 16% is meant to be per annum. So we need to convert it to be so it should be able to give us, there is 3 zeros at the top, you round off after 3 decimal places when you are using the thousands. So when you compute, it is giving us how much? So you get 2 millions, 6. So point, because there are 3 zeros at the top. You can have it like that. So we shall be able to apportion it on that basis. Then apart from that overlapping interest penalty, we shall also be required the discount on issue of the new bond. Discount on issue of the new bond. So we also incur some costs on issuing the new bond. So discount on issue of the new bond, you go to the paragraph number 2. We go to the paragraph number 2. So in that paragraph number 2, they had stated that due to the decline in the treasury bill rates in the recent past, interest rates in the money market have been falling. So a financial analyst engaged by the company to assess the possibility of refinancing the debt reports that a new shillings 100 million par value, 12% 5-year bond will be issued by the company. So issuing cost of the new bond will be 5% of the par value. And the discount is what percent? 3% will have to be given to attract them investors. So it will be 3% of the par value. it will be 3% of the par value. So that discount on the new bond, you simply take 3% and the par value of the new bond is also 100 million. The par value of the new bond is also 100 millions. It is also 100. So it should be able to give us how much? So it will be giving us 3 millions. Then apart from the discount on issue of the new bond, you also add the issue cost. Issue cost of also the new bond. The issue cost of also the new bond. It is also found at the same point. It is also found at the same point where they also had stated that the issue cost of the new bond will be 5%. Where we got the 3%, there was also 5% of the par value, which is 100 million. So when we compute that figure, it should be able to give us, it is 5 millions. So first you add them together to get the gross cash outflow, so that we get now the gross cash outflow. So you add them together so that we come up with what is supposed to be the gross cash outflow. We add them together so that we get the gross cash outflow. The gross cash outflow. So when you add them, they are giving us a total of, sorry, we get 20. It is obvious 20. Hii mbili na hiyo ni tatu na hiyo ni mbili, si ndio? Na hii ni tano, zikakuwa 10, na hiyo ingine ni 10. So what should be the total value? So it is obvious must be 20 plus something. Because the first one is 10, the second one is 2, then 3, then 5. So there should be 66.67. So that is now what should be the gross cash outflow. But we need to less the tax for some of those figures. We less the tax associated with. We need to minus the tax associated with. Some of them are taxable, so we need to less the tax on those particular items. So one of the items to be taxed will be the call premium. The call premium. So the same amount for the call premium, you record it there. We record it there. We shall combine them together, then we multiply by the tax rate. The other item should be the overlapping interest. The other item should be the overlapping interest. Interest penalty. Interest penalty. So this one will be 266. Then 667. So the discount and the issue cost on the new bond, we cannot pay tax today. We have not replaced it. You want to replace it. You are only looking at the cost we incur to issue the new bond. So we cannot tax the discount and the issue cost on the new bond. But instead, we shall tax the one for the old bond, because it was a contract that you entered into, so you need to pay. So today, when you go through the question, they had stated in the first paragraph that a motor vehicle assembling issued a 10-year, 16%, shillings 100 million par value 5 years ago. So it was issued 5 years ago. So they had also stated, when you continue on the same, the bond was issued at a 2% discount, and the issuing cost amounted to how much? 2 million. But when you check in the last paragraph, when you go through that last paragraph, not the last, but the second last, where we were told that that second line after the penalty, after the 2-month interest penalty, we have to be paid on, they said all bond issue expenses, including the interest penalty, are to be amortized on the straight line basis over the life of the bond and are allowable for the corporate tax. So amortization is like writing them off. Amortization is to write them off. So that means that it was issued 5 years ago. So the one for the first 5 years, it has been paid. The tax on the first 5 years has been paid. So the one which is remaining is for the remaining 5 years, because it was meant to be for 10 years, but it was issued 5 years ago. So we have stated that we cannot pay tax on the new bond because it is not existing. We are only calculating the cost to incur to get now the new bond. But old bond is still existing. We have not been able to refinance. So there was tax that has not been paid for the remaining how many years? 5 years. Because it was issued 5 years ago. The remaining period is another how many years? 5 years. So that discount is to be written off on the straight line basis. So if we can start with the discount on the old bond, we can do a small working up there. We can do a small working somewhere. So we still require like 4 lanes before we finish the question. So you can jump 4 lanes so that we do a small working. We do a small working, whereby we need to get the discount per annum on the old bonds. So we can do a working where we get the discount per annum. Discount per annum on the old bond. Discount per annum. So that discount per annum on the old bond, if you check in the first paragraph, they had said that the bond was issued at a 2% discount. So get 2% of the old bond, which was also valued at 100 million. So divide by 10 years, because it was supposed to be there for 10 years. It was supposed to be there for 10 years. So how much would be the discount per annum? Because the total discount on the old bond is 2% of the par value. That is the total. But we want per annum. The bond was supposed to be there for 10 years. So divide by 10 years and see how much was it to be. So it will be able to give you 200,000. But we want for the remaining period. Because if it was there for the last 5 years, it means the tax for the last 5 years has been paid. We are looking for now the remaining period that it has not been paid, so that we factor it in at that point. So now to get an amortized discount on the one that has not been written off. So an amortized discount will now be, because per annum it is 200,000, but we multiply by the remaining period. It was issued 5 years ago. So how many years are remaining? So multiply by the 5 years. The 5 years is the remaining period, because it is amortized on the straight line basis. For the first 5 years, it has been written off. So the remaining has not been written off. So in case it has not been written off, it means we have not paid tax on it because it is on the straight line basis. But it was a contract that we entered into. So we must pay that tax on that amount that we have not written off. So that amount should be how much? It will be giving you 1 million, like that. So that figure, we include it among the items to be taxed. So we include there an amortized discount on the old bond. On the old bond. So that figure is 1 million. There are 3 zeros at the top, so it just have it as 1 million and that. Then, apart from the discount per annum on the old bond, the other item should be the issue cost per annum also on the old bond. We also do another working where we also calculate the issue cost per annum on the old bond. We also compute the issue cost per annum also on the old bond. Also on the old bond. So you check in the first paragraph. You check in the first paragraph. When you go through the first paragraph, you are told that the bond was issued at a 2% discount and the issuing cost amounted to how much? They gave us 2 million. So you also take the 2 million. This time they gave you the amount. The other one they gave you the percentage. So here they have given you 2 million. We also divide by the 10 years because it was supposed to be there for 10 years. So that we get per annum. So it will still be how much? It will also be 200,000. It will also be 200,000. Then you also now compute an amortized issue cost. We also calculate the unamortized issue cost. So it is also the same figure because it is 200 multiplied by the remaining period, which is also 5 years. It will also be 1 million like that. So that we now also include it there as an amortized issue cost. Issue cost also on the old bond. So it is also 1 million like that. It is also 1 million like that. So now those figures, we shall add them together. Then we multiply by the tax rate because we want the tax on this item. So the question had given you the tax in the last paragraph. You can see in the last paragraph, the corporate tax applicable is what percent? Yeah, so get 40% now of those values. So add them together, multiplied by 40%, so that we get the tax on those 4 items. So that we get now the tax on those particular 4 items. We get the tax on those particular 4 items. So that we come up with the tax on those 4 items. So how much would be that tax? Itakuwa which figure? 58. Point what? So subtract this figure from this gross slash out. We now subtract this from that, so that we get now the initial investment to issue the new bond. So once you subtract, we shall now come up with the initial investment to issue the new bond. Issue the new bond. So that we come up with the initial investment in order to issue the new bond. So it should give us around which figure? So we get 14,800. So that is now our Roman letter 1. How you are to come up with the initial investment required in order to issue the new bond. The initial investment required in order to issue the new bond. So now we go to the Roman letter 2. We should now check the Roman letter 2. So Roman letter 2, they were asking you to calculate annual cash flows or savings, if any, expected from the bond refinancing decision. They would like you to come up with annual cash flow or savings, if any, expected from the bond refinancing. So to compute those savings, to calculate now those savings, so to compute those savings, what we need to do, we classify them. We shall have the old bond. We shall be having the old bond and also the new bond. So you want to see, not on a photo. Where are we lost? Is someone lost? Sorry? The issue of the tax. Yeah, so I explained and I stated that interest is taxable. It is stated in the question. Interest is a taxable expense. Also, the penalty, it is still interest. It is also taxed. Even the discount and the issue cost are taxable. But now, when it comes to the taxing part, I'm using for the old bond because the new bond is not existing. The new bond is not existing.
This one was issued. It was a 10-year bid.
Yes.
And we have come from the past 1 year to 5.
Yes, yes. So that tax has been paid because it is on the straight line basis. So you want the one that you have not paid, so that we factor it in. You must pay that tax, that bond, because you borrowed money. They calculated the costs. It was part of that costs. Processing fee. See, they incurred it. But the only thing, it was spread over the 10 years. So it had already been captured. And it was part of the processing fee. So now you have not paid it for the remaining 5 years because it was to be paid on the straight line. Okay, so now we bring it there, the one that has not been paid. And now we get the tax credit.
Yeah. The tax which was captured, which is for 10 years, was captured as part of our cost. So
yes. Yes, yes, yes. Yeah, that's what I mean. The issue here is that we are issuing a new bond to replace the existing bond. So you want to get the total cost, we need to incur to replace the bond. So one of the costs is the penalty, which is the premium. You have to pay. Then, kuna hiyo overlapping interest, you have to do what? Pay. But now you are issuing a new bond. There will be a discount you incur to issue the new bond. Also, another issuing cost to issue the new. So those are the four costs that you must incur. But they are, all of them are taxable. All of them are taxable. So when it comes to the taxing part, the call premium is a one-time element. So that one will be taxed the full of it. The one for the penalty is also a one-time cost. You also have to get tax on it. But now when it comes to the issue of the discount and the flotation, the issuing cost, they are to be spread on the straight line basis. They are to be issued on the straight line basis. So at that particular point, we get per annum. So for the first 5 years, it has already been paid because it is on the straight line basis. But now there is a remaining 5 years that you have not paid, but it had been captured as one of the costs when you are incurring the old bond. So it must be paid because it was only spread, but it had to be paid at that particular time. So that's why we take for the remaining 5 years, the one that has, then we tax it. We are only looking for the tax on that part you have not paid. Then for the new bond, we cannot tax the issue cost and the flotation cost on the new bond. They will be calculated separately. Now you are dealing with the remaining 5 years for the new bond. But here we are only capturing it, initial cost to be incurred to replace the new bond. It is like the deposit you paid, maybe for the house. So there are expenses that were to be incurred. So it is supposed to be refunded, isn't it? But now, before it is refunded, they capture the damages that had been done. So the damages in this case was like the prospectus of preparing the issuing of the new bond. So that prospectus was prepared in year 1, isn't it? So we cannot recover that. We cannot, because those lawyers were paid. The lawyers were paid their fee and they paid net of the tax. So it must be brought at this particular point. So I hope it makes sense briefly at that point. So let us check the Roman letter 2. Annual cash flow or savings, if any, expected from the new the bond refinance. So the cost there is the savings in terms of the interest. So I will split it into 2. I will split it into for each one of them. So the first item will be interest per annum. The first item should be interest per annum. So you want to spread those. So for the only bond, you check in the first paragraph. The interest per annum on the only bond, you check in the first paragraph. So when you check in the first paragraph, it was 16% of 100 million. So get 16% of 100. So here we are taking the total interest per annum. It will be how much? It will be 16 million. Also calculate for the new bond. It will also be 12% of the 100 million. It is also, when you check in the paragraph number 2, under the financial analyst engaged by the company to assess the possibility of refinancing the debt, reports that our new shillings 100 million per value, 12%. So we get 12% of that 1200 of the 100 million. So this should be able to give us which year? It is 12 million. So now we less the tax associated with. We less the tax associated with. So the first item will still be the interest. Interest per annum. So those figures, I put them under this first column. The same interest, we bring it here at that time. Then, apart from the interest, there is also the discount. Also discount per annum. For the old bond, we had already calculated that item for the old bond. So when you check in the first paragraph, you remember the discount was what percent? 2. Remember, it was 2% of the 100 million. But you are dividing by 10 years in order to get per annum. So it was how much you had already calculated. It was able to give us 2 million or 200. It was 200. We just recorded it at that. Then for the new bond, you do the same. The new bond, you remember it was it 3%? Yeah. It should be 3% of also the 100 million. But this one you divide by 5 years. That one is divided by 5 years because the new bond will be there for the next 5 years. The old bond was for 10 years to get per annum. So this one will give you which year? So that's the same as it will be 600. Then also issue cost per annum. The issue cost per annum. So the issue cost per annum for the old bond, you remember in the first paragraph we are given 2 million. We are also dividing by 10 years. We are also dividing by 10 years. So it will still come to, it was also 200. For the new bond, it is 5% of also 100 millions. You also divide by 5 years because the new bond will be there for the 5 years. So this should be able to give us which figure? Sorry. It will be 1 million. Right. So add them together. This one multiplied by 40%. And we record it there. Also this one, we also multiply 40%. Mm.
25%.
Yes. Then we divide by 5 years to get per annum. Because the bar value for the 2 bonds were the same. They were all 100 millions. So this one should be new here. So then 16. $54.40. So we are subtracting this from that, also this one from that, to get annual after-tax cost. So that we get the annual after-tax costs. So the one for the old bond is giving us which value? 9440. The one for the new bond should be which year? 6560. Yeah, so we want to get the savings. We compare the one for the old bond and the new bond. Then we net them. So we get the annual after-tax cost savings. The annual after-tax the annual after tax cost. So you simply take the one for the old bond, which is 94.40. You subtract the one for the new bond, 65.60. 65.60. So that we get now the annual after tax cost savings from the bond refunding. Which will be which one? Sorry? 2880 like that. Yeah, so there are 3 zeros at the top. That's why I'm now including that portion. There are 3 zeros at the top. So that should be your Roman letter 2, where you are meant to get the annual cash flow or savings, if any, expected from the bond refinancing. So finally, there is also the Roman letter 3, the net present value. We now need to compute the net present value. We need now to come up with the net present value. So NPV is supposed to be given by present value for the cash inflows minus the present value for the cash outflows. So first, I want to show you how to get the discounting rate. So discounting rate, it will simply be before tax cost of the new bond. Before tax cost of the new bond. Then we tax it. So when you want to calculate the discounting rate, it is simply before tax cost of, so this cost is simply the interest rate. That cost is simply the interest rate. So if you check in the paragraph number 2, or what you have applied, the interest rate for the new bond was 12%. Then we need to tax it. That is, the corporate tax rate was 40%. So we minus 1 minus, we multiply 1 minus 0.4. Minus, we multiply 1 minus 0.4. So it was even. But now I want to show you how they came up with the value. So this one is giving us which value? It is 7.2, but they have rounded it off. They have said approximately 7%. It is given in the question. It is given in the question where they have stated that, and after tax cost of the debt to the company is approximately what percent? So if it is not given, remember to calculate it as the discount rate. So now we compute the present value of the cash inflows. We now compute the present value for the cash inflows. So it will be annuity multiplied by present value interest factor for the annuity. Annuity multiplied by the present value of the interest factor for the annuity. So it is 7% multiplied by, it was for how many years? 5 years. So this annuity is the savings we have at that point. You see the annual cash inflows. That will be the savings. So we get now in the table. There is cumulative table and single table. So when it is annuity, we use the cumulative. So you multiply only once. I will not multiply 5 times. So then you often that your kit. Malibu asked me whether I had shown you how to use the tables. What did you do yesterday that was bringing complication? Multiplying by 3 years or multiplied by once. So we only multiply once. We don't multiply 5 times, isn't it? Because we are using the annuity table. Because the figure that was given was from the annuity table. So if it is for the annuity table, we only multiply once. But if you are using the first table, you go each year. You take, then you add all of them. But now this one is what? Annuity table. So what figure are you getting from the table? It is 4.1. 4.1002. Yeah, so you only multiply once because you are using the second table. The second table is the annuity table. But if they gave you the figure for the first table, now you go year one, you take the same figure, multiply by the one for year one, like that. But if it is the one from the second table, we only multiply once. Then now we less present value for the cash outflows. We less the present value for the cash outflows. So this one is what you got in Roman letter 1. So present value for the cash outflows is what you are able to get in the Roman letter 1. You remember what we got in Roman letter 1? Lipata which figure? 14,800. Remember what we got in Roman letter 1? Yeah, that was the initial investment for the refinancing. That is what we calculated in the Roman letter 1. So this other one has given you which figure? 11,808,576. So now when you subtract, that is what will give us the NPV. That is what will give me the NPV. So we are getting a negative NPV, whereby now you need to advise in the Roman letter 4 whether to refinance or not to refinance. So for this one, we advise them not to refinance. So they should not refinance the existing bond as it will lead to a negative NPV. So the existing bond should not be replaced. That's what you are meaning. So the existing bond should not be replaced as it will lead to a negative NPV. That is if replaced. So that is now what we can get from there. So also the only question I can see in that past paper is that question on the bond refunding or refinancing. So we can have a short break. Then when we come back, we go to the leases. There is another item. The last one should be the lease, so that we see whether by tomorrow we should have finished the long-term financing decision. So let us have a short break before we proceed. So I
Sasa mimi natakiwa nini shwari?
So we can now go to the list as one of the long-term financing decisions. We now check the one for the list. So in the notes I gave you on the handout about the bond refunding or refinancing, you also have information on the list. So listing is given. So, but we know much about the lease. It is simply where you rent the property to use instead of buying. So what we normally do, we compare the cost of renting and the cost of buying. So leasing is simply to rent a property in order to use. So we shall not discuss more about the theory part. What should be practical is the computation part of it, because they don't test at your level the theory when it comes to the leases. We simply compare when you buy and when you lease, which one is cheaper. So we pick the one which is a little bit cheaper. So we shall be calculating the present value of leasing and the present value of buying in order to assess whether to buy or to lease. So the first question, there we have two questions, but I would like us to start with the one for December 2011. We start with the one for December 2011. There is a question number 1, December 2011, question number 1. So the item there is the lease or the lease, which is the third item under the long-term financing decision. Remember, we started the adjusted net present value, then the bond refunding or refinancing. Now we look at the lease. So check December 2011, question 1. Check December 2011. There is a question number 1. December 2011. There is a question number 1. So that question 1, part B. Question 1, part B for December 2011. December 2011, question number 1, part B. So that question 1, part B is about Motor Limited. Is considering whether to buy a certain machine costing 100 million or to lease the machine So it is estimated that the machine will reduce variable cost by 13 million, by 31 million per annum. The machine will also have an 8-year. It will also have an 8-year life with no salvage value. So the machine will be depreciated on the straight line basis. The company's optimal capital structure is 50% debt to the total asset, and it is before tax cost of debt and the cost of equity are 15% and 25% respectively. The corporate tax rate is 30%. So if the company were to lease the machine, the fee will be 21.4 million per annum paid at the end of the year. Assume that the lease is what? A finance lease. So required, so finance lease is normally long term. There are normally two key, operating lease and the finance lease. So finance lease, it goes beyond 1 year, but operating lease is normally within 1 year. So required, Roman letter 1, net present value if the firm decides to buy the machine. Roman letter 2, net present value if the firm decides to lease the machine. Then finally we advise. So we start with the first part, which will be leasing. So the issue there is the discounting rate. The issue should be the discounting rate. So discounting rate will be the WSC. The discounting rate should be the WSC. So to compute the weighted average cost of capital, to compute the weighted average cost of capital should be given by the weight of equity, the cost of equity, the weight of debt. So KD must always be after the tax. So those proportions are already given to you in that last paragraph where they said that the company's optimal capital structure is 50% debt, which means equity is also 50% because there are only two items there. So the weight of equity is 50%, which is the same as 0.5. And when you check the same sentence, they gave you the cost of debt and the cost of equity. So what should be the cost of equity? There is 15 and 25. One of them is for the debt and the other one is for equity. So the one for equity is 25. The one for equity is the one. So they have said that before tax cost of the debt and the cost of equity are 15% and 25. So 25 will refer to equity. So this one will be 25. Then we add the debt is also 0.5 because there was 50%. So the one for the debt is 15%. But it must be always be after the tax. Corporate tax rate was given us. So multiplied by 0.7. Multiplied by 0.7. So that we get, because it must be after the tax. We get 17.75. So that will be your discounting rate. That should be our discounting rate. Like that. So we start with the Roman letter 1, the NPV. So NPV of buy, so buy option. So Roman letter 1 is the buy option. Roman letter 1 is buy option. So NPV is supposed to be given by present value for the cash inflows. We minus present value of the cash outflows. So NPV should be given by the present value for the cash inflows. We minus the present value for the cash outflow. So we prepare the cash flow statement to get the cash flows to be discounted. We prepare the cash flow statement to get the cash flows to be discounted. So in that regard, we check in the first paragraph where they say that the machine was to cost 100 million, but it is estimated that the machine will reduce the variable cost by how much? So we start with the savings on the variable costs. We shall have the savings on variable costs. The savings on the variable costs. That figure is given as how much? It is 31 million. So you have 31. You can have 3 zeros at the top like that. So now we minus depreciation. We less the depreciation because it is on the straight line. So to get the depreciation, you see the initial cost in the first paragraph. It was 100 million, but there was no salvage value. It was 8 years with no salvage value. So you simply take 100 million, divide by 8 years. We divide by 8 years so that you get the depreciation per annum. Sorry? Like that. So when we minus, we get the savings before the tax. We get the savings before the tax. So then 18,500. Then now we less the tax. So when we less, we get the savings after the tax. So we add back the depreciation because it is not an actual outflow of cash. So after that, add back back the depreciation. So that depreciation was filled what? So that you get now the annual cash inflows. So that to get the annual so it should be 20. So that is now the cash flow that we should be discounting. So once you have done that, we also want to get the cost of capital, the discounting rate, which is 17.7, but that figure is not the table. 17.75% is not. So you should also calculate that figure. You should also be able to compute that particular value. Whereby it should be that 1 minus 1 plus r divided by r. So it should be 1 minus 1 plus 0 point. It was 17.75. Correct? So we can have it like that. So n should be 8 units. Also divide by 0.1775. Round off to 4 decimal places will be 4.1093. So we can now get the present value for the cash inflows. So it is annuity multiplied by the present value interest factor for the annuity. So 17.75% for 8 years. So annuity is 25,450. This figure that we calculated. So now you multiply by 4.1093. So that should give you the present value for the cash inflow. So now you less present value for the cash outflows, which was basically the 100 millions. So there are 3 zeros at the top. Just have it like that. Then you get now the NPV. So that would be now the NPV for buying. That is now the NPV of buying the machine. So we compare the one to this. We shall compare the NPV of this. Compare the NPV of when we list. Compare the NPV of this. So let us now check Roman letter 2 for the lease. So we are still calculating the NPV, but now we also prepare the cash flow statement. We also prepare the cash flow statement when you lease. So whether you lease or you buy, there will be savings in the variable costs. There will be savings in the variable costs. Remember it was how much? It was 31. So when you lease, there is an expense that was given down there. You see when you lease, whether you buy or you lease, there must be savings in the variable cost. Whether you buy or you lease. Then, in addition, you can see before the end of the question, they said if the company were to lease the machine, the fee will be how much? So we less that fee. We less the fee from that figure. So we less the lease fee. Minus the lease. So that figure is meant to be cos 21. So that we get the savings before the tax. So how much is that savings? So when you lease, there is no depreciation. The asset does not belong to you. You are only paying rent to use the asset. So we did not buy. So there will be no depreciation under the lease. The asset is not ours. We are only paying rent to use the asset. So there will be no depreciation under the lease. Then now after that, we now less the tax. So the tax is 30% of 96. It's 30% of the 96. 28. So that we now get 67. So that is now our savings. Sorry? 30% of this. Yeah.
Everything is okay.
You like to take a side?
Yes.
We still have 2 weeks before exams. Is it okay at that point?
Yes, it's okay.
So you get the savings after tax. So that is now the same as our annual cash inflows. So now we get the present value of the cash inflow. So it will be annuity multiplied by the present value interest factor for the annuity. We still use the 17.75% for 8 years. So our annuity is the 67.20. So we had already calculated 17.75% in year 8. Yes. That figure was 4.10. 4.10. Yeah, so that figure would just be in that order. So we are supposed to minus the present value for the cash outflow, but it is not there. You see the 100 million? It is not there under this. We did not pay the 100. You have just rented the property. You are paying rent. So it is zero. Yeah. That initial investment under the lease is not there. The only thing you are paying is that fee. Then from the fee you have had the savings. So now you get your NPV. When you are releasing, initial cost is not there. That's why there was no depreciation. That's why there were not. So it is giving you how much? 27,614. Yes. Yeah. So now we compare the buy and the lease. Which one is giving you the highest NPV? Yeah, so always the lease is cheaper compared to buy. So we advise them in the Roman letter 3. Roman letter 3, they wanted you to advise the company on whether to buy or lease. So the advice is that lease the machine. Lease the machine since it has a higher NPV. We lease the machine since it has a higher NPV. We lease the machine since it has a higher NPV. So there is another question which is there, September 2021. So now we check the one for September 2021, question number 3, part B. So the next one is September 2021. Question number 3, part B. September 2021. Question number 3, part B. So are you able to see September 2021, question 3, part B? Yes. Yeah, so let us go through the question. They gave you details that Celtex Limited intends to acquire a mainframe computer for processing and storage of its data, for processing and the storage of its data. So the computer is expected to cost shillings 800,000. It is expected to cost shillings 800,000. So the finance director has made 2 proposals for acquiring the computer. Has made 2 proposals for acquiring the computer. So proposal 1 is leasing option. Proposal 1 is meant to be the leasing option. So under the leasing option, they lease the computer for 5 years before the new model is what? Introduced. So the lease payment constitute of shillings 150,000 per annum for 5 years. Then repair and maintenance costs incurred are estimated at 100,000 per annum for 5 years. So the firm will choose to exercise the option to buy the computer for 100,000 after how many years? 5 years. So that is now the lease option. They also gave you purchase option. So under the purchase option, they are saying that the firm can borrow 800,000 from a commercial bank at an interest rate of what percent? 16% per annum to finance the purchase of the asset. Interest on the loan is payable on the reducing balance basis. Then salvage value of the asset is estimated to be how much? 150,000 after 5 years. So depreciation is on the reducing balance basis. The corporate tax rate is 30%. Service and maintenance cost will amount to 80,000 per annum. So required evaluation of both option 1 and option 2. Then your advice. So the starting point again is to get the cost of capital or discounting rate. We should also be able to calculate the discounting rate. So discounting rate in this previous question, it was the WSEC. But for this question, we have no information given for equity. There is no information that has been given for equity, but they have given us the interest rate. The question has given us the interest rate. So to get the cost of capital or discounting rate, so to get our discounting rate. So discounting rate will simply be equal to, it will simply be equal to, we get the interest rate on the bank loan. Are you able to see under the purchase option? That interest rate on the bank loan is what percent? Yeah, so we get the 16%, but it must be after the tax. It must be after the tax. The corporate tax rate was given as what percent? 30%. So minus 0.1. So we only get the interest net of the tax. 11.2. So 11.2, we can use roughly 11%. 11.2, we can just use roughly 11% because it's too close to 11. So we also calculate, because we are now on the lease option. We are now on the leasing option. So this time, there are no revenues, there are only costs. Where they said that lease the computer for 5 years before the new model. So leasing payment constitutes of how much? 150 per annum for how many years? Yeah, so we have the lease payment. We start the lease payment. The lease payment, which is meant to be, is it 150,000? Then, apart from the lease payment, there is another cost they have given you. Repair and maintenance costs are to be estimated at 100,000 per annum for 5. So there is also repair and maintenance. Repair and maintenance. Repair and maintenance. So repair and maintenance is 100,000. So we get the total costs. We get before tax costs. So that will give us before tax costs. Like that. So it is giving us 250. So we need to less the tax, because those costs are normally tax allowable expense. So now we less the tax. Tax was 30%. So it is 30% of 250,000. It's 75. So when you minus, we now get after tax costs. Now get there after tax costs. So after tax cost should be 100 and what? 175. So we want to get the present value of the costs. So this time we are simply computing the present value of that costs. So it is annuity multiplied by the present value interest factor for the annuity. So we have calculated it was 11% for 5 years. So our annuity is the 175,000. Our annuity is the one which is 175,000. So when you check in the table, 11% for 5 years in their earned table. 3.695. 59. Use the second table. We are using the second table, and so that is the correct field. Yes. But they also gave you some more information under the list. So after you have reached the machine, they gave you the exercise option to buy. So we also factor in the option to exercise. So there is exercise of the option. So there is that part of the exercise of the option so that you buy. So this one will only occur once. That exercise of the option, it will only occur once. So we discount it using the first table. We discount it using the first table. You also incur some cost at the end to buy the machine. You see the exercise option to buy. They buy it at how much? Yeah, so that is a capital expenditure. It's not normally taxed. So that figure of 100,000. So we use the first table because it is only occurring once. After you have used the machine, the option you must buy the machine. You see that statement? They have said that the farm can choose to exercise the option to buy the computer at how much? So it is obvious they must be able to buy. They have been given that option. So when you use the first table, 11% in year 5, it is 0.59. Yeah, so now add them together. That will now give you the present value cost of leasing. That now should give you the present value cost of the leasing. Now give you the present value cost of the leasing. That's now when you lease. That should be the total cost being incurred. When you lease, that now will be able to be the total cost to be incurred. So how much is that cost for leasing? 706. Yeah, so that is now the lease option. So there is also the buy option. So buy option is a bit longer. We cannot be able to finish now. I want us to do it when we are fresh tomorrow. So we shall stop there for now. When we meet, we shall now check that item. So we should be able to finish that item tomorrow. Then there will be the remaining part of that replacement. Then once we finish the replacement, now we check on the derivatives. So we must be able to finish latest by Wednesday. Yeah. Yes. Hakuna shida. Tunataka kupita. Hakuna kulala saa hizi, you read. So you want to pass. This is the lead time. The last minute will always save a human being. So you forget what you have been doing previously, isn't it? You are working. Now you dedicate yourself or not. And actually, the last minute is always the best because you are preparing for something you are sure of. So when we meet tomorrow, we shall see the remaining part.